Hello, YouTube. The pain trade continues to be higher, so we want to ask ourselves just how much more is left in the tank. And I think the answer might surprise you because when we look here too, our seasonality chart, it tells us a very clear story. We note that it's usually up into April, sell in May and go away and come back on Labor Day. So we take a leg higher, we pause, we go higher, then we go higher more. Market usually wants to go up. I want to focus in here on the end of February going into March. So let's actually take a screenshot here. Let's blow it up for those boomer eyes and for everyone who was on their phone. So let's have a look here. And what do we note? We see a inverse head and shoulders here on the pattern, pretty much starting at the end of February and then completing into, I don't know, like call it the last third or last one quarter of March, where we just go higher. So this is really interesting because when we look here to our daily chart, what do we have? Well, we have a left shoulder, a head, and a right shoulder. It's not perfect, but I would say it's probably close enough. That left shoulder coming in when? Oh my goodness, right into the end of February. Our head into mid-March, and now our right shoulder over here is looking like it just wants to leg up. And this is really interesting to me because I'm noting, well, there's still this gap on the chart here. So I was debating what to talk about on today's video, but I think I have a very clear story. And as we all know, there ain't no party like a bull party. So let's talk about the bulls. Let's see what these bulls got in the tank. The pain trade continues to be higher. And because we have this daily gap here, we don't really note huge volume, but there is more than the previous session. So this for me just means that if this was the low, it's not going to probably show up on the daily chart. It's going to show up on the weekly chart. We got a gap down. And ever since our gap down, we have been advancing. So let's have a look here. We have our gap down pump up. But here is the part that I need to see for fresh continuation. We're 100% doing defense. Defense for me means higher lows. In terms of offense for the last 2 weeks, this week we are close to last week's high, but we are not yet over it, which means we have an inside bar. So until we crack over 402.49, this is consolidation. It's bullish consolidation with strong defense, with a gap down pump up, which is usually a sign of capitulation. We take the elevator down, gap down, pump up. That's usually bullish. So that's what I'm watching on QQQ. We have to note a key area here too. It's 315.25. So as of right now, same thing. Very good defense, which means higher lows. In terms of offense, high, higher, high, lower, high. So we have that flag forming here or the inside bar. We also have a ramp in volume. So 1, 2, 3. So in terms of the question that we noted at the start, how high can we go from here? Well, I think it really depends on where we close out March and what we do into April, because we have some key data coming in, including PCE on Friday. But this is just what normally happens in the last 20 years, averaged out. And what do we normally do? Well, we go straight up starting at the end of March. So are we going to leave this daily gap on the chart, or are we maybe going to, fill it before the end of the month? Come on, mouse. Stupid smart mouse from Apple. Here we go. Anyways, going back to the chart here, if we don't fill this gap before advancing, that means that maybe we fill it tomorrow, maybe on Friday, and then starting on April 1, we just go higher. If we leave this hole here, it's not great, but if we close over the 50 DMA, again, for a couple of bars here, start to flag out over top of it, it's not that we can negate the test. All gaps get filled usually over time. Doesn't mean we have to fill it right now. It's just usually what happens. So if we can flag out over this 50 here, I'll be watching it. So let's get the rest of this news out of the way. And I want to be mindful of this because what we're looking for here is the next 3 months. So first quarter is going to close out. That's January to March. Well, March to June, well, yeah, market should go up. Normally, again, we're up a lot more than what we normally do. But if we look here, end of April, we're up about, I don't know, call it 1%. Into the end of the next quarter, where are we? Well, end of June, we're usually here at about 2.5. That's roughly 2 times what we've done so far, which means whatever SPY's done so far year to date, it's about 5%. We should double up. And that would take us back up to where? Like back up to roughly our highs. That's right. Roughly 420, roughly 10% on the year. Okay, so the percents don't match, but the velocity does. Yeah, the velocity looks like it would match here. Going from roughly 1 to roughly 2, that's a 2x. And if we think about this, what's really important is kind of what I've been mentioning before regarding the recession or a rolling recession. So we're set for a strong print of 3% for this most recent quarter. But we have to remind ourselves is that how do they measure this? Well, it's measured on an annual rate, adjusted annual, right? It's the annual rate. So if we think about, okay, Q1, well, Q1 is comparing to this first dip here with 0.37. Then we look at the next one, it's negative 1.3. So this next quarter or going into Q2, there is a high probability that we could at least eke out a little bit of gain. Why? Because as long as it's above zero, the negative number from last Q2 is going to reflect as a positive one. That's how we can do the higher for longer, right? Squeeze the bears. And man, these bears are getting hurt. I'm going to ask you one time, please and thank you. If you could smash a thumbs up and consider subscribing to the channel, I would really appreciate it. Thank you ahead of time. So with this fear and greed still high, what do? Well, we buy fear and we sell greed. So what's really interesting to me is that as we're exiting fear, going into neutral, that's pretty much what I talked about here on we can't just play defense now. We have to play offense, which means we need to see that higher high. We need to see the continuation. And as we've noted on the monthly chart and things before, it's just really important we get above that area. All right, so moving forward here, right, that's done. We talked about the fear. So if we're going to go into neutral and then to greed and we're going to continue higher now, we need higher highs. Why? Well, because the pain trade is what's driving the market right now. So we noted these levels for, I don't know, like about a week or two now. Median price here on ES from when that big short was put on last June, 3966. The largest zone is 4020. That's going to clear this top pocket right here. That's what we're doing right now. 4120 is the next notable zone. So the big short was initiated about a year ago. And at the end of Q2, that'll be a 1-year anniversary. Can the pain trade continue or to go up? What was really interesting, too, is we got intraday volatility when the FDIC said they were mulling squeezing biggest banks as it plugs a $23 billion hole. So what happened? Well, you might not even notice it, right? We just went up. So, yeah, all dips got bought. We rallied up into the close. That's the story. So we got a negative headline, potential punch to the bulls. Why? Well, because banks report in about 2 weeks, and that's a $23 billion hole, which means they're going to be looking to suck up about $23 billion in profit from the big banks. What are they going to guide when they start reporting earnings in about 2 weeks? I'm not sure, but that's a big headline. All right, let's get to the meat and potatoes. Why? Well, because it's a tectonic shift. Sector stats to watch. Tech is the second best S&P 500 sector so far this year, or up about 18%. It's also on pace for its best quarter since Q2 of 2020. That's right, almost 3 years ago now. And Bitcoin is actually set for its best quarter since Q1 of 2021. We went through a lot more stats, but what's really interesting to me that I heard today from CNBC is just that the largest 5 stocks account for 5% on the S&P 500. So when we look at this now, S&P is now, let's look at SPX just to make sure we look at the index. It's currently up by 4.9% this year, which means that 4.9 out of 5% is just from 5 stocks. So what was so interesting to me is I went through here. I tried to make this a little bit more easy to follow, and I'll show you a couple of charts now. Since you're watching all the way till the end, let's show you the good stuff. So let's go here to SPX. Let's just look here. So we note that it's up about 5% on the year, and that's largely because of NDX or the NASDAQ. So NASDAQ here, we noted that area. We got our potential head and shoulders. So if we don't continue higher right now, that could be where we stall out. It could be where we start to give back some gains. Why? Well, because when we look at RSP, man, this is like no man's land. That's a fat doji. So far this year, it has done a whole bunch of nothing. What else has done nothing so far this year? Well, the NYSE's done nothing. It's down by 0.4%. The Dow is red. Russell is up by 1 point. XLK is up. Financials are red. Healthcare is red. Energy is red. Utilities are red. SMH is green. And ARC is green, but not really doing all that great. The DAX is also up 10%. FXI is up 4. Emerging markets is up about 3. Banks are up today, but they're down dramatically on the year. And what that tells me is that, and like we can note here, just looking at the one-day chart, we noted this yesterday. We have a hollow candle again today, which means we've actually expanded for 2 days on regional banks. And we've not done that since we had that goes all the way back to mid-February. It's been about a month and a half since we've had 2 back-to-back hollow green bars. Oh my goodness, is the crisis over? I think the bears are going to be crying some tears. So what this really comes down to is what we look at here year to date, and let's just go no group. The S&P has gone basically nowhere. That's what the RSP shows us. And other than these 5 mega cap stocks, the market really needs some extra breadth and more of stocks to continue higher instead of just being red. So as we're looking to the end of the quarter, let's please make sure we understand all of this stuff. If you haven't already, I would encourage you to watch the weekend review, which is now queued up here on the left-hand side. If not, thank you so much for watching. I look forward to seeing you tomorrow.